So we created a bank account that pays 17 to 20% by combining digital capital with a digital credit instrument with a digital treasury company that issues securities to pay the dividend. And I'd love to tell you that I had figured it all out before we started, but we really tripped over digital capital, and then we developed digital credit out of desperation to avoid credit risk. And then we used the ATM to fund the dividend, and we discovered it was all going to be return of capital dividend. And the punchline is, I think we created in strategy the world's most tax-efficient, scalable generator of fixed income.
The most recent decline in Bitcoin is not being driven by a weakness that is exclusive to cryptocurrencies, but rather by a shock that is dominated by the IT industry. As Michael Saylor explains, the United States technology stocks had a severe sell-off, which was spurred by fears of uncontrolled expenditure on artificial intelligence and rumors of an imminent tech bubble. This caused the Nasdaq to fall, and Bitcoin mimicked the decrease in real time. Because Bitcoin BTC has fallen below $86,000 for the first time since April, the close relationship that it has with large technology companies has been evident. Some market analysts, such as Ray Dalio, recognize that values have become inflated. But they do not see any quick catalyst for a systemic meltdown. A hotter-than-expected data on employment in the United States. Added pressure by reducing expectations for rate cuts by the Federal Reserve. This resulted in a worsening of sentiment across the board, including in the cryptocurrency market. Concerns regarding major artificial intelligence infrastructure buildouts and debt-funded data centers escalated, and even solid profits from heavyweights such as Nvidia and Walmart were not enough to steady the mood. Until macro clarity is restored, traders are being cautious, which is keeping Bitcoin bound into volatility dictated by technology.
I think for Bitcoin and the entire crypto industry, for it to 10x from here, the major catalyst is the embrace and adoption by the major banks. So the actions of JP Morgan, Bank of America, Wells Fargo, BNY Mellon, PNC Bank, the support that's coming from Schwab, from boutique banks like Texas Capital, all of those are big actors. The actions of Morgan Stanley in the space, they led our IPO of Stretch, which was the biggest IPO of the year, and it's basically a Bitcoin-backed credit instrument. So I think probably the most auspicious thing is to see, I didn't mention Citi, but the support that's coming from Citi, from JP Morgan, from Wells Fargo, from Bank of America, all of those banks are revising their crypto policies, which were very restrictive and blanketed as of a year ago, and they've changed their view toward the entire industry and toward crypto assets as collateral in the past, in some cases, 4 weeks. So this is a very important month. I give them the benefit of a doubt. If you roll back to the crypto winter, the regulators shut down, and I would say almost assassinated Silvergate and Signature Bank. Those were two good banks that were put out of business by the previous administration.
On a Sunday.
And that traumatized the entire banking establishment, right? If you combine that with the guidance that came from the Fed and the regulators, I think they were all traumatized, and their view is like, hey, the bank's been around for 100 years. I'm not going to blow it up on my watch. And so they all took very conservative, extremely paranoid policies. And maybe the paranoia was injected into them by the administration. I think after November 5th, we knew there was going to be a new view toward digital assets, but I don't think people realized how constructive and positive it would be until you got 12 pro-crypto, 12 pro-Bitcoin cabinet members. And then Scott Bessent went out of his way as the Secretary of the Treasury to make sure that Treasury and the OCC and the FDIC and even the Federal Reserve provided very positive, constructive guidance to those banks that now it's safe It's safe for them to start to custody. It's safe for them to start to issue credit, and it's safe for them to trade and handle this asset. And so if you look at it from a pragmatic point of view, these are the largest, most risk-averse organizations in the country. And from the point that it's safe to do something, to expect, I would think, oh, it might take 4 years. And so the fact that it's happening, we're not even in the first anniversary of the election, right? The fact that they're actually moving in the 11th month, when it was a death sentence to move 12 months ago, I think that that's very auspicious. And I think you got to take your hat off and applaud the people that are running these trillion-dollar organizations that are able to start to lead their organizations to a better place. Now, having said it, they're not crypto native, they're not tech companies, they're going to move methodically, they've got a lot of people, a lot of moving parts, a lot of constituencies to please. So I think it'll be 4 years of progression before, maybe the 10% tech leaders have the kind of stack of services that they want. Over under would have been outrageous. And and the irony though is Vanguard was very explicitly anti-crypto, anti-Bitcoin. And Scott, who is my biggest shareholder?
I do.
Vanguard. Okay, so they, no force on earth can stop an idea whose time has come. And right now you have 750 million people in the crypto ecosystem. You have something that I think when I got into the space 5 years ago, it was a $200 billion to $250 billion industry. It was $2 trillion 12 months ago. It's $4.5 trillion right now. There's an avalanche of capital, an avalanche of people, armies of people, and their view is this is an idea whose time has come. And even, Vanguard got big because they invented equity capital. The Vanguard 500, the idea that you just want to buy a chunk of equity without taking any counterparty risk. You buy a mixture of 500 companies. And that was their big thing, equity as capital. And now we've got digital capital. And of course, it's a new paradigm. They'll be a bit slow, but they can't help but invest it because money is indexed to invest in credit and is indexed to invest in equity. And once you've got 250 companies that are holding digital assets, and once you start having credit instruments backed by digital assets, the people that run those funds have to own those things. They can't not.
As a result of Ether's performance below $3,000, nearly an entire year's worth of gains have been wiped out, dealing a severe blow to investors and treasury corporations who own significant ETH investments. The value of the asset has dropped by 30% in a single month and has reached a level not seen in 4 months. Technical indications are indicating that there is a risk of a further decline toward the $2,500 region. ETH rolled over from its highs and eventually retested the long-term, to 100-week moving average before stabilizing, which coincides with the reappearance of a bearish fractal that happened in 2022. This pattern is almost comparable to the one that occurred in 2022. The same support zone is now the last stronghold for bulls, despite the fact that Ethereum has already dropped more than 40% from its top in 2025. There is a growing amount of pressure throughout the ecosystem as the momentum on the blockchain slows down and the pressure to sell increases.
Say Bitcoin is like a 45 vol, 45 ARR asset, and you can't hold money that you need in 2 weeks in Bitcoin because you might have a lot or not as much. So Bitcoin is a long duration asset. You want to hold it for 10 years, 120 months, and you're going to be on a 45 volatility roller coaster, and you're going to make a lot of money, and you got to believe in it. You get on the street and you ask 100 people, do you want that? Most of them don't want that. You retire, your father, your retirees, fixed income, they don't want that. So What do they want? Well, some people think I want to have my cake and eat it too. Can I just have 75% of the upside, no downside, and just give me the rest as a fat dividend, like 8% dividend? And that's kind of interesting to people, and we created that. That's a convertible preferred stock called STRK. That was the first digital credit instrument we created. Like upside, a lot, 80% of the upside, 10% of the downside, and a fat dividend while you wait. And then the next thing we created was a 10% dividend forever. How do you pay a 10% dividend forever? You won't find Apple or Microsoft. If the CFO of Microsoft walked into the boardroom and said, I want to pay a 10% dividend forever, he'd get fired. Okay, so we created that because the reason we wanted it is we intend to invest the money forever. We're going to take the $1 billion and we're going to buy $1 billion of Bitcoin, and my forecast is Bitcoin goes up 30% for the next 20 years. It goes up 20% forever after that. So our long-term forecast is we know we're going to do double, maybe triple that, and we want the money forever. So if you have the best use of proceeds or the best collateral, then you can offer the highest yield. And so we did that, and that was the next deal, and that was more successful than Strike. And then we created a third deal, a third instrument called STRD, STRD, and there we stripped, this is a joke, we stripped the investor protections off it. We said that STRF was a cumulative preferred with penalties if we missed the dividend, and STRD was a non-cumulative preferred, no penalties if we missed the dividend. And you're like, well, why would anybody want to buy that one? It's because the STRF product traded above par, and it was yielding 9%, and we sold STRD below par, and it yields 12.5%. And so if you actually believe in Bitcoin and you like the company, you're getting paid 350 basis points extra. And if you just want the extra 3 paragraphs, you give up 3.5% dividend forever. And so we created a junk instrument on purpose. And along the way, we realized that what people really want is they just want a high-yield bank account. They want a money market that pays them triple. And so the fourth exercise was Stretch, STRC, and it's the one I wish I did first, but I couldn't have done it first without doing the other 3 to figure out what people wanted. So the idea of Stretch is you pay a monthly dividend that's cash. That's right now it's 10.25%. When we took the thing public, it was 9%. But we pay a dividend and we target par value. So we target the instrument to trade between 99 and 101, and it's trading about 98.7 or almost 99 right now. And the idea was we're going to strip away the delta. There's no upside from Bitcoin. We're going to strip away the risk. We're going to 7x or 10x over collateralize it. We're going to strip away the volatility. The vol of Bitcoin was 50. Strike got to 30. Strife got to 20, Stride got to 15, and this got to like 5 to 7. So we stripped the volatility away, and then we stripped the duration away. Instead of you holding it for 120 months, like how many people want to buy a 20-year bond? Not many. How many people want to buy a 20-year crypto bond? Not many. But how many people want a money market that pays them 10% instead of 4%? A lot of people want that. So we just kind of created something that looks like a money market instrument, 1 month, a 1 month Bitcoin bond that right now pays about 10%. And while we did it, in order to do it, we created a variable dividend where the company can change the dividend every month. And so if it's trading weak, we raise the dividend. If it's trading too strong, we lower the dividend. So we kind of created our own currency, Scott, like the pound or the euro. But if you wanted a Bitcoin backed or a crypto dollar, we created that instrument with the risk-free rate or the rate of 10.25%. Now, that's the one we're most excited about because that's the highest degree of financial engineering we've done. It's like extracting kerosene from a barrel of crude oil. It's like pure jet fuel or rocket fuel. Now, along the way, So we ended up creating instruments that yield 9 to 12.5%, which is like double or triple most credit. But then we tripped over this very interesting, magical thing. We didn't expect it. What we realized is if you sell equity to pay the dividend becomes tax-free. So the dividends are return of capital dividends, ROC dividends, we call them. So what you're doing is you're returning the capital to the shareholder or the creditor. So Stretch is not a bank account that pays 10.25%. The tax equivalent yield is 17% if you live in Florida. And it's 20% if you're a New Yorker. So we created a bank account that pays 17 to 20% by combining digital capital with a digital credit instrument with a digital treasury company that issues securities to pay the dividend. And I'd love to tell you that I had figured it all out before we started, but we really tripped over digital capital, and then we developed digital credit out of desperation to avoid credit risk. And then we used the ATM to fund the dividend, and we discovered it was all going to be return of capital dividend. And the punchline is, I think we created in strategy the world's most tax-efficient, scalable generator of fixed income.
Treasury businesses that have a major portion of their holdings in Ethereum are experiencing significant losses as their once high-valued holdings collapse into deep unrealized losses. Major holders, such as Bitmine Immersion Technologies, have seen billions of dollars removed from their paper valuations as a result of today's declines, which range from 25% to 48%. There have been a number of leading companies that have fallen below a market value to net asset ratio of 1, which indicates a decline in confidence and makes it far more challenging to raise financing. While this is going on, reserves and exchange-traded funds have lost more than 280,000 ETH since November, which is a strong indication that institutional buyers are pulling out of the market. The data, when combined with the fact that on-chain activity has decreased and momentum indicators have become less strong, suggests that the correction of ETH may not yet be complete.